So you've built equity, you've worked really hard, and now you're ready to move into a larger home because the current home just doesn't fit your lifestyle. And now someone could be online and is telling you, hey, just use an ARM. You'll get a lower monthly payment, you'll qualify for more home. It's a no-brainer. I've been hearing that a lot from influencers, online calculators, and people that mean well, but if you're not educated on what an ARM is, it could seriously hurt your family. So before you take that advice, watch this. Because an ARM is not a bad product, but it is absolutely the wrong tool in the wrong hands. And by the end of this video, you're gonna know exactly which one you are. Quick intro, I'm John Farrell. I've been lending for 25 years and I've learned a lot of things over that time period. But one thing that I've really taken to heart is I grew up in a household where finances were a mess and it frankly tore my family apart. And I created this channel to give more clarity so that you and your family can make the right decision. Not the decision that feels good in the moment, but the one that protects you long term. Okay, so let's talk about adjustable rate mortgages. I want to address something head on because I've seen a lot of talk about ARMs and some really good stuff and some stuff that I'm like, I don't know if that's really good advice for the consumer. And I understand why that sounds appealing. An ARM, it starts off with a lower fixed rate than, let's say, a 30-year fixed rate mortgage. And a lower rate means your debt to income ratios look better on paper, so you could potentially qualify for a more expensive home. And that part is technically true, but here's what they leave out. And this is the part that keeps me up late at night. If you can only qualify for that more expensive home because of the ARM's lower payment, well, that's not really buying a home. Because rates can adjust, there's life changes, income changes, things happen. And when your affordability, or what we call your debt to income ratio, is maxed on a 30-year fix, if any of those things happen, you're maxed out on the runway. I have a lot of experience with this because at the home that I grew up in with my family, there was financial stress and it drove tension day in, day out in the family. It's not something I would want to put another family through. But here's the flip side. An ARM, it can be one of the best tools if used correctly for the right type of buyer. Let me show you the difference. Let's level set on mechanics, because understanding this separates a smart decision from a stressful one. So what is an ARM? An ARM is an adjustable rate mortgage where the interest rate is fixed for a set period of time. So let's say a 7-1 ARM. 7-1 ARM, and I'll use an example rate of 5.5. The interest rate of 5.5 is fixed for 7 years, and then after the 7 years, it can go to an adjustable rate where it can adjust either once or twice a year. And here's the part that many may not know. An ARM is not just an unlimited amount of adjustments, it has caps. A typical 7-1 ARM either has a 5-2-5 structure or a 5-1-5 structure. And what that means is the first adjustment, the rate can go no higher than 5% above that initial note rate. So if the rate initially is 5.5% and rates were extremely high at the time when it went to an adjustable, the highest it could go that first adjustment is 10.5%. There's going to be various types of ARMs. You could have a 3-year fixed ARM, a 5-year fixed ARM, 7-year fixed ARM, or a 10-year fixed ARM, where the interest rate is fixed for any of those intervals. But they're all going to have caps. So let's just say on this 7-year ARM, if you see 5.15 or 5.25, what that means is the initial adjustment after that 7 years, the rate could go no higher than 5% above, let's say you locked in at 5.5%. What the 2 means is after that second adjustment, the rate can go no higher than 2%. So let's just say the rate stayed the same and didn't adjust that first year. The second year, it could go no higher than 7.5%. But over the life of the loan, if you kept that ARM, it could go no higher than 5% above that initial 5.5% rate, which would be 10.5%. So yes, the rate can go up, but it really can't go up without a limit. And if you've planned correctly, you shouldn't still be in that ARM if it adjusts anyway. Lenders offer lower introductory rate ARMs because they're taking lower long-term risk. And then you will be bearing some of that risk after year 7. In exchange, they give you a better rate up front, typically between 0.375 and 1% compared to a 30-year fixed. On a $700,000 loan, that could be hundreds of dollars lower per month. And over the years, that's a lot of money put back into your family's hands. So this is the core of everything. Let me give it clean to you. So here's an ARM done right. Your debt to income ratio, you're comfortably qualified on a fixed rate too. Why would you be using an ARM? To optimize and save money strategically. And if there's rate adjustment risk, you're resilient, your budget, it absorbs it. Maybe there's an exit strategy, a clear plan. You sell, refi, or pay down the mortgage. And the most important is working with the right mortgage team that's actually managing your mortgage. So if an opportunity comes up during that fixed term to refinance, maybe you go into another ARM or a 30-year fixed. So when is an ARM done wrong? If it's there just to get you in that larger size home because of the payment, it's probably not a good idea. You're just going to be stretching yourself thin. If any of these descriptions sound like your situation, it's not me judging you. This is protecting you. If fixed rate mortgage in a home you can comfortably afford is far better than the foundation of a stretched ARM in a home that owns you. So who's the right candidate for an ARM? You're already comfortably qualified for a 30-year fixed rate, but you're choosing this ARM as a strategy and not a lifeline. Or your debt to income ratio and affordability, you've got room. You're not pushing the threshold. And let's just say there was an adjustment. It might be tight, but it's not breaking the budget. An ARM can also be a great tool if you've got a realistic plan. Maybe you're planning on moving or selling, or you're used to ARMs and you know how the rates work, and you really believe that there's going to be an opportunity, somewhere in the near future where you can refinance it again. Here's the part of the conversation that no one talks about, but this is where the strategy lives. If you take the 7-year ARM, and let's assume that interest rates do come down, and historically they do, you do not have to wait until year 7. A great mortgage team, they're not there just to close your loan. They're actively monitoring rates, and when an ample time comes to refinance, they can take you from that 7-year ARM and put you into another 7-year ARM, extending the term again. Think about what that means. You get another 7 years of a new locked lower rate, and you never reach the adjustment. You keep the savings going, and you refinance when another opportunity comes. So this really isn't gambling on rates. It's proactive mortgage management. But, and this is a big but, this only works if you have someone in your corner watching rates. Not a call center, not a company that sold your loan 3 times. And that is the difference between a transaction and a relationship. And it's the entire way I built my business over the last 25 years. So before you decide anything between fixed and ARM, I want you to answer these 4 questions, not for me, but for you. Am I comfortably qualified on a 30-year fixed rate for this home? Not barely, not with a stretch, comfortably. If the answer is no, stop here. A fixed rate is your answer. What is my realistic plan for this home in the next 5 to 10 years? Are you planning to move, sell, upgrade, or pay down significantly? Do you have a clear horizon shorter than the ARM's fixed period? An ARM may make sense. Would a lower monthly payment create real financial opportunity for my family? Investing the difference, building savings, paying down the principal faster. Is there a genuine strategy attached to the savings, or is a lower monthly payment just making a too expensive home feel affordable? And the last question, am I working with a mortgage team that is actively managing my loans so that when interest rates drop, I can refinance into a new ARM or fixed and reset the fixed period? This question matters more than people realize. An ARM without active management is just delayed uncertainty. An ARM with a great team behind it is repeatable strategy. So here's my honest take after 25 years of doing this. The ARM, it's not the villain, the advice is. Using a financial tool without understanding it or a team that's not managing it, that's what creates the financial stress. I've seen ARMs protect families and create massive wealth. I've also seen ARMs that create damage when the wrong people use them for the wrong reasons. And the difference is usually this: was it strategy or a shortcut? The lowest rate isn't always the best deal. The right strategy is.